Good morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. 2 weeks ago, the US 10-year yield hit a cycle high at 5.02%. Since then, the 10-year note is down more than 40 basis points to 4.59%. What happened to cause this outsized move? First came the Treasury refunding announcement that was smaller than markets had feared. Afterwards, we had the weaker data from the US on both the labor as well as the economic front. Amidst all this movement, Rupee has remained range bound and begs the question, what next? JK, if you could indulge this question of mine and probably in the minds of many of our listeners.
Yeah, good morning, Swaraj. Yeah, I mean, if you're asking me about the impact of this on the rupee, I think in the short term, not much, because rupee has anyway been not reacting much to the global events and the global moves also. And while we were seeing a good recovery in the risk sentiment and also the when yields are falling, as well as the Chinese yuan also strengthening, rupee remained steady at its usual range, and the usual buyers were there and the usual sellers were there as well. I think near term this is not going to change, and as I've been saying for several days, it's the flows that matter, and the flows are currently negative. As and when we see large flows, and that is when we see some strength, which could be seen in the INR. But that said, Monday was all about consolidation of the big moves that Friday had, unsurprisingly done by the yields retracing the big, into the big falls. Treasuries, tens fell over 10. I mean, treasuries actually retraced 10 basis points after falling to below 4.60 on Friday. And then twos also rallied by 11 basis points, 30s up 88 basis points. Now, there are so many shorts that were there in the market. That was the reason why we had a stop loss buying of treasuries or falling of the yields that we saw on Friday. But the question remains whether one indicator is good enough to say that US economy is slumping, and then therefore the yields and the rates have to be lower. That is the biggest question that everybody is trying to get an answer for. And we might get some clues when the Fed Chairman Powell speaks on IMF policy on November 9th, and investors will be eager to see if he agrees with the dovish hold interpretation of the market of the last week's FOMC decision. Now, in fact, fall in yields is definitely seen as a double-edged sword. Ironically, a continued slide in treasury yields and a strong rally in stocks on growing perception that Fed is done raising rates can put actually Fed on the guard and prompt some pushback on the two dovish interpretation, because easing financial conditions again leads to more consumption and higher inflation possibly. In fact, Fed members did not lose much time in saying that the job report alone was not enough to conclude that there will be no more rate hikes, and Kashkari was very clear on that. We also had ECB members springing up to say that there will be, we should stand ready to hike again if needed. That was the statement, and of course, standing aside. In fact, an outlier in the central banks is the Australian Central Bank, which is considered likely to resume raising rates at a policy meeting today, as inflation there stayed stubbornly high. And this is a big departure from major central banks who have been on a pause but holding on to higher for longer. Now, coming to equity, they just consolidated in narrow ranges after having seen the best 1 week gain last week. The news of the day was that South Korean authorities, banning short selling of stocks till June 2024. That led to gain the market by about 5.5%, and this is the fourth time the country has implemented a ban on short selling after 2008, 2011, and 2020, when the major event shook the global markets. And this time it's been in response to a series of short selling violation by the foreign firms. On the data, we did not have much, but the senior loan officer opinion survey that comes every quarter showed that the credit conditions on loans to businesses as well as the personal loans were tightening as reported by the banks. So that was the point that Fed also has been looking at, but whether it will sustain in view of the sharp fall in the yields, that is something that we need to look at. My own view is that Treasury is not done with the major part of their borrowings for the year, and therefore the supply will ensure that the yields don't go much further down from these levels, and that will ensure that the risk sentiment remains a bit guarded. And don't forget the Middle East conflict, which is still ongoing, although there were some indications that there could be some pause in the attacks on Gaza, as per the some reports that we are reading. On the major currencies, Euro and GBP hit recovery highs yesterday, 1.0760 on the Euro, and more than 1.24 on the GBP, but all of them have again retraced. The overreaction to the non-farm payroll report is getting corrected. Yen is also above 150. I think the surprise mover came from the Chinese yuan, which broke 7.28 also yesterday. And there is some perception that the Chinese economy could be seeing some sort of a bottom in the growth picture, and that's the reason why the incessant selling of yuan has taken backseat. In fact, the market can be right in the sense that some of the trade related numbers that came today has been seen a better picture, particularly on the imports. Imports have risen by 3% versus a fall by 6.2% last month, and expectation was for another fall of 4.8%. However, the exports are still down at 6.4%. Overall deficit picture has was also deteriorated because the imports were higher and exports were falling. But overall, it does look some improvement in the economic activity as far as China is concerned, and that is good for the risk. Thank you.
Thank you, JK. And I'll just quickly summarize. Rupee was non-reactive to global moves, even the strength in Asian currencies, which we saw yesterday. As JK mentioned, is the flows that matter, which are negative as of now. Monday, the theme was the consolidation of the big moves on Friday. Now, the real question would be whether the data is actually indicating a slump in US economy, or the dovish interpretation which has happened after the Fed meeting. It might lead to some statements by Fed members to correct course. Euro and GBP hit recovery highs yesterday, but we have seen some retracement to this recovery move. As I mentioned earlier, Asians saw some strength. Chinese yuan broke 7.28 yesterday. Now, perception is building that the economy might be seeing some bottom, and recovery should follow. That's it from us today. And one more thing before we end is that we have a geopolitics webinar on geopolitics today between 5 p.m. to 6 p.m. Being delivered by a very well known geopolitics analyst, Professor Nalapat, who is also the UNESCO Peace Chair. So the link will be in the description. Do tune in today between 5 to 6 p.m. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.